Welcome back to the Deep Dive. Today we are going deep, really deep, into one of the most, I think, strategic corners of the Japanese industrial landscape. We're talking shipbuilding.
We are, and specifically we're unpacking the recent history and really the explosive turnaround of Naikai Zosen, ticker 7-year-up1.
That's an absolutely fascinating story.
It is. I mean, when you track Naikai Zosen's financials from, say, 2006 all the way to 2024, you see this company just struggling, just fighting through the relentless ups and downs of global shipping.
And then suddenly this massive profitability in 2023 and 2024.
Exactly. So our mission today is to figure out how to really extract the key strategic shifts, the levers of profit that took them from being almost $1 billion yen in the red to these staggering multi-billion yen profits in just a couple of years.
And we've got the documents to do it. A long view spanning almost 2 decades, which lets us see the actual strategic decisions, not just, the quarterly noise.
Right. And this isn't just a commercial story. This dive is critical because Naikai Zosen sits at this really unique intersection. On one hand, they're facing this intense global pressure from competitors in China and Korea. But on the other, they hold this unique strategic advantage that's tied directly to Japan's national security. It's where global commerce really meets domestic defense.
Okay, let's unpack that. Who exactly is Naikai Zosen? Are we talking about some kind of industrial giant, or are they playing a much more specialized, more nuanced game?
Oh, definitely the specialist. They're a highly regarded mid-sized shipbuilder known for their technical skill, their precision.
Okay.
Their core business is, well, it's all shipbuilding, new construction and repairs, and it's all happening out of their 2 main factories, Satoda and Enoshima, both down in Hiroshima.
And what about the product mix? What are they building that really sets them apart from the big commodity shippers?
The product mix is, I think, the key to their stability. They build high-value commercial ships, RO ships, product carriers, that sort of thing.
Right.
But the critical part, their real differentiation, is in their strategic work. They build naval vessels, patrol vessels, and training ships.
Ah, so that's the defense angle.
That's the defense angle. It's specialized work with very high barriers to entry, and crucially, it gives them this stable, non-cyclical revenue stream. It's their anchor when the commercial market storms hit.
The sources also mention this other segment. So beyond the massive steel hulls, there's a supporting cast of other businesses.
There is, and it's mostly run through their subsidiary, Naikai Engineering.
Yeah.
You've got land operations, which is things like civil engineering, some solar power systems. And then you have the more peculiar part, service operations. We're talking hotel management, restaurants, even gift shops.
A hotel, that's interesting.
It's a fascinating little indicator of management focus. We'll definitely come back to that one later.
And we can't really talk about this company without discussing its relationship with Hitachi Zosen Corporation, or HITS. How deep does that alignment really run?
It's essential. It's the stabilizing factor. It's a massive governance nugget you have to understand. By 2021, HITS held almost 40% of the company.
So they're a huge shareholder.
More than that, the operational integration is what matters. HITS is their entrusted partner for buying all their raw materials.
So HITS buys the steel and the components for Naikai Zosen. That sounds like a powerful source of leverage in securing supplies.
A massive source of leverage.
Well, let me challenge that.
Yeah.
Doesn't that also make Naikai Zosen, vulnerable? Vulnerable to HITS' own supply chain issues or their pricing demands? How much independence do they really have?
And that's the productive tension in the partnership, right? They sacrifice some independence, yes, but what they gain is immense stability. For a mid-sized builder trying to compete against global giants, having a massive partner like HITS managing that commodity risk and, the volume purchasing, it's a huge operational shield. It's essential for their survival.
That partnership is clearly an anchor. But this company has navigated some seriously choppy waters. Let's trace that history, especially the shifts in ownership and that dramatic recent turnaround.
Yeah, the early history has some drama. If you go back to 2009, you see this major capital event. An investment partnership was the top shareholder, holding about 35%. But they immediately sold a huge block of their shares. And that single transaction vaulted Hitachi Zosen into that #1 shareholder spot.
So it wasn't a gradual shift, it was a sudden one.
Exactly. It solidified HITS' role from just a strong partner into their primary financial custodian. It just injected this deep stability into their whole governance structure.
And all through these changes, Their commitment to building those specialized defense and security assets has been a constant.
It has. That work, building naval ships and patrol cutters, it confirms their role supporting Japan's maritime security. It means they maintain this technical expertise that is incredibly hard to lose. It's a high-margin revenue stream that really stabilizes them.
Okay, let's talk about the swings then. Because the documents show this sharp plunge, a real crisis around 2020. That was brutal.
That crisis was a harsh reminder of their global exposure. In 2020, they recorded an ordinary loss of 862 million yen and a net loss of 971 million.
And just to break that down for everyone, ordinary loss means their day-to-day operations were losing money.
Correct. And the net loss is the final bottom line, that nearly billion yen operational deficit. It just shows you how things like a pandemic, raw material spikes, and supply chain breakdowns can instantly torpedo a shipbuilder.
But then came the stunning reversal in 2023. This is really the heart of our deep dive today.
The rebound was phenomenal. It was driven by, I think, both strategic execution and great timing. In 2023, sales surged. It led to a record ordinary profit of over 3 billion yen.
From an 800 million loss to a 3 billion profit.
An incredible leap. And here's the critical indicator for the future. New orders soared to 64 billion yen in 2023 alone.
64 billion. Just to give that some context, their total sales for that same year were around 44 billion. So that 1 year's order intake is nearly 150% of their annual revenue.
Exactly. That locks in massive future revenue.
It's huge.
That backlog, it just signals immense market confidence. It shows they successfully negotiated new contracts at favorable prices right when shipping demand was picking up.
Let's shift to that global picture. Shipbuilding is so reliant on international trade. So where's all this revenue coming from, and how do they manage the currency risks that can just devour profits for Japanese exporters?
Right. Overseas sales are their backbone, consistently over 70% of their sales. Sometimes, like in 2019, it's closer to 78%. Their fate is tied to global trade, not domestic consumption. And their client base is dominated by Latin America, Panama specifically, which is a huge flag state for shipping, and then followed by Asia, like Singapore.
Now, let's talk about that critical financial defense mechanism you mentioned, the yen contract fortress. Why is their policy of demanding yen-denominated contracts so important? I mean, doesn't that risk losing clients to competitors in South Korea or China, who often price their ships in U.S. dollars?
That is the core trade-off. And yes, they absolutely could lose some price-sensitive, commodity-focused contracts. But here's the thing. Naikai Zosen is not building cheap commodity ships. They're building specialized, high-spec vessels, eco-ships, naval assets.
Where quality and reliability matter more than the absolute lowest price.
Exactly. For those high-value buyers, financial stability and, guaranteed delivery timing often outweigh minor currency convenience. By insisting on yen-denominated contracts, they remove that massive volatility from the equation.
So they're willing to sacrifice some volume on the low end to lock in stable margins on their high-end specialized contracts. That just takes one of the biggest variables that haunts Japanese exporters right off the table.
It gives them incredible financial stability in their core operations. But, minimizing FX risk doesn't eliminate all financing concerns. The sources show their financing costs are rising.
Interest payments and so on.
Right. Interest payments, funding costs. It was around 174 million yen in 2023. And that's a cost that's only going to grow if global interest rates keep climbing. It just chips away at those hard-won profits.
Okay, this is where it gets really interesting. So you have this environment, huge backlog, stable contracts, but rising costs. What are the 2 or 3 key variables that are going to define Naikai Zosen's performance over the next few years? Let's find that hidden commercial logic.
Okay. I think we can isolate 3 major variables that will dictate their future EPS and ROE. The first is the perpetual shipbuilding battle, the cost versus price squeeze.
Right. The squeeze between the fixed price of the ship they agreed to and the volatile price of all the steel and components they have to buy to build it.
Precisely. Raw material costs, especially steel, are a massive input. They pressure profitability directly, and this has been a consistent theme in their reports going all the way back to 2006.
So if they have these fixed yen prices on their contracts, how do they fight back when steel prices are shooting up?
Their counter strategy is pretty sophisticated. It's 2-pronged design-led cost reduction and very strict selective ordering.
Design-led cost reduction.
It means they optimize the ship structure before they even start building. They reduce the number of welds, they standardize hull sections, they engineer efficiency to use less material and less labor from the very beginning. It's structural innovation designed purely for margin protection, and any success there, you can see it immediately in higher gross margins and, of course, stronger earnings per share.
And the second variable has to be execution, right? Especially with that gargantuan backlog we talked about.
That's variable two. Capital investment and execution risk. That 64 billion yen in new orders is driven by the global market demanding these specialized high-spec vessels, your eco-ships, your low-emission carriers. But a massive order book only translates to a high return on equity if they can actually build those ships efficiently and on time.
And for anyone unfamiliar, ROE, return on equity, it just measures how effectively management is using shareholder money to generate profit. So poor execution means a low ROE.
Precisely, and execution requires continuous capital investment. We saw clear evidence of this. They bought 3 new cranes in late 2019, and they're constantly reinforcing their facilities at the Enoshima factory.
So the risk is that if production fails or they miss deadlines, that beautiful backlog turns into a liability.
It turns into low ROE, high penalty costs, and operational chaos. Execution, enabled by smart capital spending, is probably their single biggest risk right now.
Okay, so what's the third variable? You mentioned that other segment earlier, the potential drag.
It is. It's what I call the non-core drag the hotel problem. Remember that service segment, specifically the hotel and restaurant called Nautique Shiroyama?
Ah, yes, the hotel. The peripheral drain that sucks up time and resources.
That's exactly what it is. I mean, while the core business is dealing in billions of yen, this little service segment has consistently generated impairment losses. 24 million in losses in 2019, another 36 million in 2020. This gets booked as a special loss.
Can you just quickly clarify what a special loss implies here, especially versus the ordinary loss they booked in 2020?
Of course. The ordinary loss in 2020 was an operational deficit. Their day-to-day business was losing money. A special loss, though, is typically a one-off thing, non-recurring. It usually relates to asset write-downs. In this case, it's them repeatedly writing down the value of their hotel. Now, while it's small in the grand scheme, this recurring loss on a non-core asset, it demands management time, it's a constant drag on profitability. It just shows you where corporate focus needs to be tighter or, ideally where they need to divest.
It's amazing how often you see that. These minor, non-core assets become major management headaches. You've got CEOs worried about 64 billion yen contracts, and their time is being drained by a 36 million yen gift shop loss. Let's talk about their capital strategy. What's Naikai Zosen's attitude toward rewarding its investors, especially given how cyclical this industry is?
The policy really centers on stability and balance. They want to generate stable profits while keeping enough cash, enough internal reserves to handle the next downturn. So their goal is performance-backed distributions, not, aggressive, unsustainable payouts.
And have they been able to stick to that through the ups and downs?
They've shown a real commitment. Even during that tough 2020 period, they maintained a history of payouts. And it's also important to remember the stock consolidation.
Right. They did a 10-to-1 stock consolidation back in 2017. What does that mean for the average investor?
It means they reduced the total number of shares by 90%, but the total market value of the company stayed the same. It results in a much higher price per share, and it often signals a desire for, a better market perception, improved liquidity. And right after this, they actually increased the dividend from 20 yen per share to 30 yen in 2018. It really shows a commitment to returning value even when times were challenging.
And finally, let's talk about the leash the banks have them on. Are there financial constraints at play here that guide their capital allocation?
Absolutely. And this gives you a deep insight into their management discipline. Their borrowing agreements, which totaled around 7.9 billion yen in 2024, they include very clear financial covenants. The most critical one is that their non-consolidated balance sheet cannot show negative equity at the end of the fiscal year.
Negative equity being when your debt exceeds your assets. So why do the banks impose that rule?
The banks are just protecting their principal. This covenant is this powerful external force that just forces management to prioritize operational stability and consistent profitability above everything else. They simply can't afford risky, high-leverage growth because they have to guarantee that the core shipbuilding business stays solvent. It makes debt management a constant focus. So, to summarize our deep dive into Naikai Zosen, the future profitability, the stock performance for the next 1 to 3 years, it's all going to be defined by 3 key commercial variables. First, can they execute that massive, surging 64 billion yen order backlog efficiently? Second, can they keep winning that fight against raw material costs through their design-led reduction? And third, can they maintain that stable, high-margin revenue from their defense contracts, which is, of course, inextricably linked to geopolitical stability?
So what does this all mean for you? We've seen that Naikai Zosen cleverly leverages its highly specialized role in building naval and patrol vessels, a stable, high-tech pillar, to balance out the risky, traditional global shipping markets. The question is this: does the shipbuilding industry's classic boom and bust cycle still fully apply to a company that is so deeply entwined with Japan's national security and defense needs? That's the strategic calculus you need to consider as you follow their journey.